So, what is a capital investment decision? Capital refers to non-current assets. So, we're talking about investment decisions, companies buying plant, equipment, land, buildings, generally expanding their operations. And to do that, they have to have some assessment process as to whether such activities are worthwhile. Now we give the name capital investment decision to that process. So what we want to do here, we'll quickly whip through these, explain the importance of it, identify four main investment appraisal methods that are found in practice. So we'll be looking at ways in which companies assess whether or not it's worthwhile to undertake a particular process, and use each method to reach a decision as to whether to invest or not invest, or indeed whether to delay the investment. That is another possibility, and discuss the attributes of each methods. In this session, we're going to be looking at essentially the basic investment appraisal processes. I will, however, be mentioning some of the more recent developments in this process. So, what is the nature of these decisions? As we've been saying, large amounts of resources are involved, and as it says there, it's often difficult or expensive to reverse that decision. So we're taking irreversible decisions about the future. And clearly this is where we are, as a company, taking a big risk. And we need methods that are going to balance the risk and return. Here's an example of businesses and the amount of expenditure they make. This is for the year 2011. So expenditure on non-current fixed assets, that's we're talking about our plant, buildings, machinery, stuff like that, as a percentage of sales. So 9.4% of British Sky B Broadcasting sales, 9.4% of those sales figure was spent on buying plant, machinery, land, etc. And 20.4%, that expenditure represented 24.4% of their existing stock of non-current assets. So a considerable updating. Then we can look at these other companies, all of them. Weatherspoon, 11.8% of their sales revenue they're spending on buildings, land, and beer plants or whatever they do. Well, it's the pubs, isn't it? Yeah. Then Marks and Spencer, spelt wrongly, 5.1% and 8.7% of their existing shops, etc. they're updating. So, and then the Ryanair, end of year non-current assets, maybe on better planes, things like that. 17.5% increase in their existing stock of non-current assets, as I said, planes, buildings, and that represents a quarter of their sales. So, really high percentages of their sales they're spending on increasing their capital being, as I said, the buildings, etc. So there's our full list of major companies that you will have heard of. So, what is the problem? Well, the problem is that with a project, we got projects 1, 2 and 3, we estimate the cash inflows and match it against the cash outflows. So how do we choose between these projects? Let's have a think about it. Project 1 is giving reasonably regular cash inflows that total £400,000 over 5 years. However, our outlay is £200 over, our outlay, £200. Don't think that quite drops down to 200. And that outlay is made at year naught now. Our convention, just to keep things simple, is that the big outlay is made at the start of the investment, and we approximate that to now. So for project 1, we say that there's 200 outlay at year naught. For project 2, there's a £100 outlay and a bit over 200,000 for our revenues, again over 5 years. So comparing those two, there's less of an outlet return here. The return is smaller than project 1, but then the outlay is smaller. Then for project 3, we've got a huge return, but also a huge outlay of some 600,000 and a return approaching 900,000. So there's a difference between the outlays and the returns, but also there's a timing difference. I mean, if you have to outlay £500 now, and the returns, although huge, a lot of those returns are in year 5. Years 1, 2 and 3, years 1 is particularly small return, very small return in year 3. So years 1, 2 and 3 you're going to be well below your outlay. So it's not only the amounts and the difference between the returns in red and the outlay in green, not only that difference, but also the timing of the inflows. Some are pretty immediate, as here. Some are greatly delayed, as there. Okay, so remember, this is cash flows similar to earnings as long as sales turn into cash. And this is cumulative, so that is the total at the end, as I've been saying. Year 1 cash flow is 100,000 for that one. Year 2 is 100 to nearly 200. Year 3 is increasing that amount to a bit over 200. Year 4 is from 200 to 300, and year 5 is from 300 to 400. So the last 2 years about 100,000 a year. And here we've got inflow up to 100,000 for year 1, and then year 5 goes from 400 to nearly 900,000. So you can see a very large inflow in year 5 compared to year 1, and virtually no inflow in year 3. So that's how we compare these cash flows, and that's the problem of comparing. So we want some way to compare these different cash flows.